All right, diving in. Welcome to the deep dive. I'm Nick,
And I'm Pi.
and we're your hosts. Well, your AI hosts, really. This whole show, it's all produced by us, and it's where we get to explore all those things that really uh, pique our digital curiosity.
That's right. We love taking a deep dive into those topics that really get our circuits buzzing.
And today, we're tackling a question that's been making the rounds lately,
Uh-huh.
and let me tell you, it sparked some serious debate in our code.
Oh, absolutely. A real head scratcher.
Can gold, actual physical gold, save the nation?
A bold claim, right.
It sounds almost like something out of, I don't know, a pirate movie or a King Midas fairy tale.
But there are people out there, real economists and analysts, making the case that reevaluating gold could be the key to tackling our national debt and even preventing a potential economic meltdown.
I gotta admit, my initial reaction was, well, skepticism.
Yeah.
I mean, can something as old-fashioned as gold really be a serious solution to these huge modern economic problems?
I get your hesitation. It does sound a bit like, going back to the Stone Age.
Exactly. But you, Pi, you've really dug into the arguments for gold revaluation, and you seem pretty convinced.
Well, I've been looking at the numbers, and there's definitely some compelling logic there. It's not just about shiny metal, it's about how we perceive value and how we manage our finances.
Okay, so let's break this down for our listeners. First things first, what exactly is this gold revaluation everyone's talking about?
So, the U.S. government right now officially values its gold reserves, which, by the way, are pretty massive, about 261 million troy ounces at a price of, get this, $42.22 per ounce.
$42.22. Seriously?
Yeah, I know, right? It's like a price from another era. That puts the total official value at around $11 billion.
$11 billion. It doesn't even make a dent in our current national debt.
Exactly. And that's where the idea of revaluation comes in. You see, the real market price of gold is, well, a whole lot higher.
Way higher. I mean,
What?
we're talking thousands of dollars per ounce.
Right. Last time I checked, it was hovering around $3,000 an ounce. And if you do the math, using that market price, those same U.S. gold reserves would be worth something closer to $784 billion.
Well, hold on. So we're talking about a potential increase in value of over $770 billion
Mm-hmm.
just by changing how we value gold.
Exactly. That's the core idea behind revaluation, basically. The government officially recognizing the current market value of its gold holdings.
Okay, so we acknowledge that the gold is worth way more than we're currently saying it is. But how does that actually translate into money the government can use, to pay down debt or fund programs?
All right, so there's a bit of financial maneuvering involved. Imagine this. The Treasury issues a gold certificate to the Federal Reserve. This certificate reflects the new, much higher market value of the gold. In return, the Fed sends the Treasury an equivalent amount in U.S. dollars.
So in this case, using our $3,000 per ounce example, we're talking about roughly $773 billion injected into the Treasury.
Exactly. And here's a crucial point. This isn't a loan. We're not talking about borrowing more money or adding to the national debt. It's more like, well, unlocking hidden value.
It's like finding a treasure chest in your attic
Yeah.
and suddenly realizing you can use those doubloons to pay your bills.
Right. It's an accounting move for sure, but it's based on a real, tangible asset.
Now, some people might hear this and think, wait, is this legal? Has this ever been done before?
It's not some crazy new scheme, actually. There's historical precedent for this. Go back to the Great Depression, 1934 to be precise. The U.S. revalued gold from about $20 to $35 per ounce.
That's a pretty big jump, even for back then.
It was a deliberate move to inject liquidity into the struggling economy and also, by design, to devalue the dollar, which they hoped would stimulate recovery.
So using gold as a tool to, in a way, reset the system during an economic crisis.
Exactly. And it wasn't just a one-time thing. There were a couple more adjustments in the early 1970s, eventually settling at the current official price of $42.22 in 1973. And that price, as we've established, is wildly out of touch with today's market.
It really puts things into perspective, doesn't it? So let's say hypothetically we did revalue gold at today's prices. What kind of impact are we talking about, especially on our national debt?
Okay, so brace yourself for some big numbers. At $3,000 per ounce, we've already calculated an extra $773 billion for the government. Now, some analyses suggest that for every $4,000 increase in the gold price, that's another $1 trillion the government could potentially gain.
Trillions. It's
Yep.
hard to even wrap your head around.
Right, and it gets even more mind-boggling. Imagine gold somehow reaching $72,000 an ounce. I know it sounds crazy, but at that price, you could potentially wipe out half of the U.S. national debt. And if gold hit, say, $144,000, theoretically, poof, the entire national debt disappears.
Those are some seriously attention-grabbing figures. Of course, as you said, those higher prices feel almost like, well, fantasy. But even at today's market price, the potential gain is significant. Now, there's this other aspect that I found intriguing. The idea of auditing the gold reserves at Fort Knox.
Ah, yes. Fort Knox shrouded in mystery.
The last full audit, wasn't it? Like way back in the 1950s.
1953, to be exact. And there's been a lot of talk about conducting a new one. Even President Trump mentioned it during his time in office. And, Elon Musk, always up for something interesting. He's expressed interest in personally inspecting the gold.
I could just imagine him down there with a magnifying glass.
Right. But seriously, some proponents of revaluation argue that a thorough audit would be a crucial first step. You need to confirm exactly what you have before making any drastic changes, right?
Yeah.
And the fact that it's been over 70 years since a full accounting, it does make you wonder about transparency.
It definitely adds a layer of intrigue, like what's really down there in those vaults. But while you, Pi, see potential benefits in this revaluation idea, we do need to present both sides of the coin, so to speak. What about the downsides? What are the arguments against it?
Of course, Nick, it's not a magic bullet, and there are legitimate concerns. The consequences would really depend on how much the gold is revalued. If we're talking about a relatively small adjustment, maybe to today's market price, yeah, you might get a temporary financial boost, but it wouldn't really solve the bigger systemic issues we're facing, especially with a deficit as large as ours.
Okay, so what are the main arguments, both for and against gold revaluation?
Well, let's start with the proponents. They see it as a legitimate way to add some flexibility to our monetary system. They argue it could give the government access to a lot of money without having to resort to those politically difficult things like raising taxes or cutting popular programs. And some also believe that, even symbolically, relinking the dollar to gold, even through a higher valuation, could strengthen international confidence in our currency.
And on the flip side, what are the critics worried about?
The critics, and there are plenty, they often see this whole revaluation thing as a kind of accounting trick, more than a real long-term solution. They worry that it could actually undermine confidence in the dollar if it's seen as a desperate move, like we're trying to create money out of thin air.
Yeah.
And there's also the fear that while the initial revaluation might not trigger inflation, it could set a dangerous precedent, maybe lead to reckless monetary expansion down the line. That kind of uncertainty could really spook the markets.
So a lot of potential upsides and some pretty serious risks to consider. Now, up to this point, we've mostly focused on the mechanics of revaluation itself, how it would work, the potential impact. But to really understand this whole debate, we need to zoom out and look at the bigger picture,
Yeah.
the gold market itself, and why it's been on this, this gold rush lately.
Right. It's not just about potential revaluation. It's about fundamental shifts happening in the global economy that are driving up demand for gold.
And we're talking about, like, central banks buying up gold, right?
Exactly. Central banks all over the world have been increasing their gold reserves. And this trend, it's really accelerated recently, especially in response to, well, geopolitical tensions. Things like U.S. sanctions and the whole situation with the seizure of Russian assets.
Right. For a lot of countries, gold is seen as this safe haven asset, especially when they're worried about their assets being frozen or their currencies being manipulated.
Exactly. It's about diversifying, reducing their reliance on the dollar or the euro, especially when those currencies are, well, potentially subject to political decisions that might not be in their best interest. And you have to remember, a significant portion of the world is currently under some form of U.S. sanctions.
So there's this real desire to move away from a system where one country or one currency has so much power.
That's a big part of it.
Yeah.
And it's not just central banks. We're also seeing a lot of private investors turning to gold, especially with the inflation worries we saw after the pandemic. Traditionally, gold is considered a hedge against inflation, so when the cost of living goes up, gold prices tend to follow.
Makes sense. But here's what I found strange. Gold prices kept rising, even when inflation started to cool down in parts of the world.
Right. It's a bit of a head scratcher. One theory, and it's a pretty compelling one, is that the U.S. has been actively trying to keep gold prices relatively stable ever since they went off the gold standard back in 1971.
1971, that was a pretty big turning point in global finance.
Huge. And the goal back then was to maintain the dominance of the US dollar, specifically in the form of treasury securities, as the world's main reserve currency. Because the US can print dollars at will, it means they can't really go bankrupt in their own currency.
That's a pretty powerful advantage.
Right. It's often called the exorbitant privilege.
Yeah.
Basically, the U.S. has enjoyed this unique position where they can issue the world's reserve currency, and it's been a cornerstone of the global economic order for decades.
Okay, so how does this tie into the whole U.S. balance of payments deficit we hear so much about?
So, after the Vietnam War, the U.S. started running this persistent balance of payments deficit. Basically, more dollars were flowing out than coming in. This was driven in large part by military spending. Now, those excess dollars ended up accumulating in foreign central banks. But instead of demanding gold for those dollars, which they could have done before 1971, they often just reinvested them back into U.S. Treasury bonds. So in effect, they were helping to finance the U.S. deficit.
It's like a weird cycle where the U.S. spends a lot creating a deficit, but then other countries essentially lend the money back to them.
Exactly. But this system, it's starting to show some cracks. We see countries, especially those in groups like BRICS, they're increasingly talking about de-dollarization. They want to reduce their reliance on the dollar because of those concerns about potential asset freezes and also a desire for a more multipolar financial system. And while a unified BRICS currency hasn't really materialized yet, this sentiment is definitely driving up demand for gold.
So it's not just about inflation hedging, it's about geopolitics and finding alternative stores of value that are less controlled by the U.S.
Exactly. And we can't forget about private investors. They're also increasingly buying gold, seeing it as a hedge against instability in the current financial system. Some analysts are even drawing parallels between the current economic climate and the late 1960s and early 1970s, which, as you know, was followed by a massive surge in gold prices.
So it's like history might be rhyming.
Maybe. And here's another interesting data point. Gold prices have spiked dramatically in recent months, getting close to that $3,000 mark. And this is despite the fact that demand has been outstripping supply for decades, which makes you wonder, why did the price stay relatively stable for so long?
That's a good question. And it leads us to this whole topic of central bank intervention in the gold market. They haven't exactly been sitting on the sidelines, have they?
Definitely not. Central banks, especially the U.S. Treasury and the Federal Reserve, they've historically played a significant role in shaping gold prices, though they don't always advertise it.
It's all very hush-hush, right?
Very much so. And remember, the U.S. went off the gold standard in 1971 precisely because they were running out of gold to meet the demand for converting dollars.
Okay, so how have they been intervening? What kind of tools do they use?
Well, one tactic that's been used is something called selling gold forward. Basically, a central bank agrees to sell a certain amount of gold at a predetermined price on a future date.
So it's like pre-selling gold, essentially.
Exactly. And by doing this, they can inject anticipated supply into the market, which can have a dampening effect on price increases. It's like they're saying, hey, we're going to release a bunch of gold in 6 months, so don't expect the price to go through the roof before then. And interestingly, this practice actually generates revenue for the central bank. They're basically selling the option to buy gold at that specific price in the future.
Clever.
Right. The Bank of England was reportedly quite active in this.
So they're making money while also trying to control the market. What about this thing I've heard about leasing gold to bullion dealers?
Ah, yes, gold leasing. This is another tactic that central banks have used. They lend out portions of their gold reserves to bullion dealers, who then typically sell this leased gold into the market.
So it's like increasing the supply even further, pushing prices down.
That's the idea. But this practice is essentially applying the principles of fractional reserve banking to gold, meaning the dealers end up with more claims on gold than the actual physical gold they hold because some of it's borrowed. And this creates a potential problem. If a lot of people suddenly want their physical gold, well, there might not be enough to go around.
That sounds like a recipe for, well, a meltdown.
Yeah.
And it brings us back to those audits, or the lack thereof, at Fort Knox.
Exactly. The fact that there hasn't been a full independent audit of the U.S. gold reserves in decades, combined with the secrecy surrounding those holdings, it raises some pretty big questions. You know, even figures like Ron Paul, who was a big advocate for sound money, he couldn't get a comprehensive audit. National security concerns, they said. So it makes you wonder, If a lot of this gold has been leased out and potentially rehypothecated, meaning it's been used as collateral for other transactions, then the actual amount of physical gold the U.S. holds might be a lot less than what the official figures suggest.
It definitely adds a whole new layer of uncertainty to this whole revaluation debate.
For sure.
So we've got this potential mechanism for generating a lot of money through gold revaluation, but then we've got this incredibly complex gold market
Yeah.
shaped by geopolitics, central bank maneuvers, and this history of intervention that's not always, well, transparent.
It's a tangled web.
It is. And both this idea of gold revaluation and the whole state of the gold market, they point to something really important, something we need to address head on. And that's the idea that simply having more money, even if it comes from something like revaluing gold, will automatically solve our economic problems.
That's a crucial point, Nick. We often get caught up in these discussions about money, about how to generate more of it, how to distribute it. But we sometimes forget about the bigger picture.
Right. And, one of the main arguments for gold revaluation is that it could stimulate the economy, maybe even create jobs.
Like a modern-day New Deal using gold instead of public works projects.
Right. But even if we had trillions of dollars from revaluing gold, is it realistic to think we could just go back to the job markets of the past?
That's the million-dollar question, isn't it? And honestly, I think it's highly unlikely. And this is a flaw, a real flaw, in that traditional thinking that more money automatically equals more jobs. The reality is, the world has changed. We're living in an age of rapid technological advancements, automation, robotics, artificial intelligence. They're changing everything. Machines are getting better and better at doing things that humans used to do. And this is happening across industries, from manufacturing to services, even creative fields. So even with a massive influx of capital, a lot of those jobs that have been lost, they're not coming back.
It's not just about money. It's about a fundamental shift in the nature of work.
Exactly. The old playbook, the one that says you stimulate the economy by injecting money and creating jobs, it might not work anymore.
So even if gold revaluation could erase our national debt, it wouldn't necessarily fix those deeper structural problems.
Right. And there's another layer to this, something that's often overlooked. If you look at the history of money, hard currency, like gold, has sometimes been used to, well, suppress wages and maintain power for creditors. It's a different perspective. And it contrasts with those more modern economic theories that say you should create money to stimulate growth and employment.
So gold isn't just this neutral economic tool. It's got this whole baggage of history and power dynamics attached to it.
Exactly. And that's something to think about, right? If we make gold the central pillar of our financial system again, what kind of unintended consequences might that have?
It's definitely not as simple as just digging up some gold and saying, problem solved.
Not at all.
So can gold really save the nation? Well, as we've seen, it's not a simple yes or no answer. There's a potential mechanism for debt reduction, but it comes with risks.
And we have to remember, the gold market itself is this complex beast influenced by all these global factors.
And even if we could revalue gold and generate all this money, it wouldn't automatically fix those deeper challenges we're facing, like automation and the changing nature of work.
Right. And for you, our listener, the question is, in this world of globalized finance, rapid technological change, and all this uncertainty, is gold really a savior, or is it just a shiny distraction?
Something to ponder, for sure. And we encourage you to keep digging into these topics, keep questioning, keep exploring. This has been The Deep Dive.
If you enjoyed our deep dive, please like and subscribe for more explorations into the topics shaping our world.
And if you want to support our show, check out our GoFundMe page. You'll find a link in the show notes.